And the observation, just 1 second, I have our observation there is that typically in reality, households and firms, private non-financial agents don't borrow directly from foreign lenders, but in general, lending is intermediated by banks, which operate in domestic financial markets. So our questions were, what happens with the key results of this literature? For example, a key result in this literature is that economies tend to overborrow. A great number of papers obtain that result, not all of them, but that's a result that has been emphasized in the literature. Is it still true that countries overborrow? If we take the prototype model of overborrowing these economies and introduce, the only modification we make is to introduce banks or a banking channel. And that's the first question, is the overborrowing result robust to introducing banks? The second question that we have is another aspect that is at center stage in this literature, which is what is the shape, what is the form, how does the optimal macroprudential policy look in this model modified in the way I just mentioned by introducing a bank. In particular, how does the capital control policy and the interest on bank reserves policy, when set optimally, look in this environment? So that's the starting point. Let me briefly, for those of you who are not, this is a seminar in international finance, so most likely you have been exposed to some form of papers in this class that I'm considering today. But at center stage, just to be on the same page, at center stage in this class of papers is a collateral constraint. And this collateral constraint can take different forms. But what is common among all formulations of these collateral constraints, and very important for this class of papers, is that it introduces a pecuniary externality. A pecuniary externality emerges when there is a variable in the collateral constraint, and in this case, it's going to be the price of objects that can be pledged as collateral. For example, if the collateral constraint is on a house, for example, in a mortgage contract, the price of the house obviously determines the value of collateral, right? The higher is the price, the higher is the value of collateral, and the larger the ability to borrow. And the problem there is that that price of the object that is pledged as collateral is taken as given by the individual agents, but it is determined endogenously in the model, in equilibrium. So it could perfectly be that people don't internalize the fact that it is their own behavior that could push that price of the collateral up and down. For example, during a boom, everybody wants to have a house or to rent a larger house. That pushes the price of the house up, and that increases the price of collateral, changing people's ability to borrow. Well, what that literature says is that that situation creates overborrowing, in the sense that households borrow too much, especially when the collateral constraint is close to be binding. And as a result, a benevolent government would like to do something to prevent this. And typically what happens in that class of models is that there is a capital control tool that the government can apply optimally, and that capital control is on average positive, especially, again, near a binding collateral constraint. Okay, so that is how these models work, essentially. We are going to keep that collateral constraint, okay? That we are going to take out of the shelf a model, a prototype model of an open economy with a collateral constraint. that's not going to change. There's going to be a collateral constraint whereby borrowing is limited by a fraction of individuals' income. But we are going to be changing that model. That's going to be the innovation of this paper by introducing a banking channel in a very simple fashion. That is why I don't call them banks. I call it a banking channel because it's a minimalistic bank intermediation technology that I will explain in a second. So these banks are basically going to take loans from the rest of the world, deposits from the rest of the world, sorry. They're going to take deposits from the rest of the world, from foreign lenders, and they're going to intermediate them. They're going to be the mediators through a domestic loan market between foreign lenders and domestic households who are going to be the recipients of those loans. We are also going to have a benevolent government exactly like in the existing literature, but now because we have one more friction, we have one more tool. So in that literature, the tools that the government count with are capital controls. We are now also going to have another tool, which is reserve remuneration. That is to say, the central bank or the government could pay interest on bank reserves to induce them to take decisions that are good in the eyes of the benevolent government. Now, let me drive you through the results. The main result of the paper are basically two. One is that under plausible calibrations of the model, this economy underborrows. That is to say, the social planet would like this economy to borrow more, to be more daring to borrow in international markets relative to a situation in which the economy is left to its own devices. And I will explain in a second why that is. The second set of results in this paper are that the optimal bank reserve remuneration policy is countercyclical. That is to say, the government, the central bank, would like to remunerate more bank reserves during recessions and reduce that rate of interest on bank reserves during expansions. So let me explain very quickly. If you can understand this intuition I'm going to explain now, you are basically with me for the rest of the paper. So a key equation in this model is going to be let me move. It's going to be this balance sheet expression here, which says the following: there are foreign deposits that come from the rest of the world that are deposited in domestic banks, and then these domestic banks can do two things with those deposits. Can either loan them to domestic agents, those are domestic loans, or they can deposit them at the central bank in the form of reserves. Now, these foreign deposits are foreign debt. Okay, so this is what the country borrows from the rest of the world. Now, if you remember the intertemporal approach to the current account or to the balance of payments, the intertemporal approach to the current account tells you that during recessions, it is a good time for the country to borrow. So debt, this right-hand side, should increase during recessions. And then the country should pay back during booms. So this external debt, these foreign deposits should go up during recessions and down during booms. Now, the literature on collateral constraints breaks that principle of the current account, or the intertemporal approach to the current account. How? Well, forget about these bank reserves. Suppose we go to the standard theory without bank reserves. So assume that this term doesn't exist. Then suppose there is a recession that brings the price of collateral down, the value of collateral down. So these guys become borrowing constraints, borrowing constraint. So these loans fall because households cannot borrow. And because loans have to be equal to foreign deposits, the country as a whole is forced to borrow less. So in that way, you're breaking the intertemporal approach to the current account, because the intertemporal approach tells you during a recession, countries should borrow more, right? So that is the whole purpose of that literature on collateral constraint, to break the intertemporal approach to the current account. The current account, instead of being, or debt, instead of being increasing during recessions and decreasing during booms, behaves exactly in the opposite way. That is to say, during recessions, these guys are collateral constraints, so this goes down. Because they borrow directly from the rest of the world, there is no bank reserve, there are no banks, so this is zero. Then during recessions, they have to borrow less. And that is painful, right? The economy is doing exactly what it shouldn't be doing. Now, what happens here in this paper is going to be that if there is a recession, these guys are still going to be borrowing constraint. They're also going to hit the borrowing constraint, exactly like in the other theory, perhaps a little bit different, but qualitatively the same, in the same way. So what the central bank is going to do is going to induce banks to hold more reserves so as to prevent the country as a whole to reduce borrowing. Why? Well, because the intertemporal approach says that they should be increasing during recessions. So the central bank is going to pay interest on reserve, higher interest on reserve, so that banks, given that they cannot lend to households because they are borrowing constrained, they could put money in reserves at the central bank. And then these reserves are going to find their way into the pockets of people via fiscal policy. So the government is going to take these resources, it's going to lower taxes and give these resources to the people. When the economy goes back to normal, it, rewinds all that, right? That's the opposite. In that way, what the government can do in this environment is to bring this economy closer to the principle of the intertemporal approach to the current account. That is to say, it can try that this financial friction doesn't get in the way of this debt going up during recessions and going down during contractions, or at least, helping that this doesn't go down during recessions. Okay, so if you understood that that principle, that intuition, that is to say, the intuition that these collateral constraints are designed to break the intertemporal approach to a current account, and that these bank reserves, if optimally manipulated by the central bank, that is to say, these are reserves at the private banks, right? The private banks investing at the central bank. If the central bank, through interest on reserves, can make these bank reserves to behave in a way as to undo the behavior of these loans, then the economy can get closer to the intertemporal approach to the current account, and it's going to be a better equilibrium. Okay, so if you understood that basic intuition, then you will be with me for the rest of this talk. So let me walk you through the model real quick. This model is going to have banks, that's the new player, and then the same agents that are in the standard literature, that is to say, households, foreign lenders, and the government. Okay, so the new guy here is going to be this bank, which, as I told you, we're going to model in a very simple way. So this is the balance sheet of a bank. The bank uses its funds in the following way. That is to say, the left-hand side here of this budget constraint is the uses of funds. The bank is going to lend part of its funds, so these are loans to households. He's going to put part of its resources or funds into bank reserves at the central bank. So these are bank reserves at the central bank. It will have to use some funds to pay back depositors. These are deposits at the banks made in the previous period, which earn this interest here, ID. The bank is also going to use funds to distribute profits. So this PIT is profits. And the bank will pay some operation cost. So this is an operations cost, the cost of operating the bank. This is what justifies this bank. This friction here, this is a convex cost that is increasing in loans and convex, and decreasing and convex in reserves. That is to say, the operating costs are increasing in loans and decreasing in reserves. Well, the assumption that they are increasing in loans is easy to understand, right? You need more employees, more paperwork, more research about the quality of the clients, etc. And the reason why this operating cost is decreasing in R is also intuitive. We don't go into the micro foundations of this. We just take it as given. But it could have to do, for example, that if the bank has reserves deposited at the central bank, the probability of a bank run goes down, and that is good for the health of the bank. So it makes sense that this cost is decreasing in the amount of reserves. Up to a certain point, there could be a satiation point beyond which reserves are not helpful in lowering costs. But within a certain normal range, these operating costs are assumed to be decreasing in the amount of bank reserves at the central bank. What are the sources of resources, of funds for this bank? Well, the sources are that they are going to get the loans they made the previous period back, the capital, including interest. So IL is the interest rate on loans. These are going to be loans to households. So that's part of the sources of funds of the bank. The bank is going to get back the reserves it deposited the previous period at the central bank, including interest. This is going to be a key policy tool for the central bank, right? By manipulating this interest rate on reserves, the central bank can alter the incentives of the bank to hold more or less reserves at the central bank. Okay, so this is going to be an important policy tool. And then the last source of funds for the bank are the deposits of the foreign lenders in the bank. Okay, so these are foreign deposits in the domestic banks. Okay, so what one has to do here is to assume a certain profit policy, right? So what rule the bank follows in order to distribute profits. And here one has a lot of leeway. What we wanted to do to impose some discipline is to say, okay, what do people do in this literature? We don't want to invent anything here. We want to take this profit policy as given. And so we follow the existing literature. In particular, we follow what Woodford and Kurdia do. And just 1 second, there's some photos here that are precluding me from seeing. Okay, here it is. So this equation here at the bottom is the policy function, right? So the bank, the private bank, the domestic private bank, is going to do the following. At the beginning of each period, it's going to say, okay, what is my beginning of the period net worth? Well, my beginning of the period net worth is everything I collected in loans, right? The loans paid back to me, the loans I issued last time, including interest, the reserves that I have at the central bank, that's also part of my net worth, minus the deposits that I have to pay back to my depositors, right? So that is the net worth. And we are going to assume, following the literature, that the bank at the beginning of each period distributes this net worth in the form of profits and then starts the period again, okay, with a blank slate. That is a typical assumption in this literature. We are going to follow it results are different if one assumes different policies? Yes, they are, because this is a friction here. So this profit function can be used to change this friction. So we don't want to play too much with this. We wanted to tie our hands by taking something that has been widely used in the closed economy literature. Okay, if you have any clarification questions, I forgot to tell you, I will take questions at the end, but also feel free by any means to interrupt me if I say something that you don't find clear. So what I want to do is I want to get rid of this pi by plugging it here. I want to plug those profits into here. And then I want to plug them again to get rid of deposits. If you do that, if you plug this profit distribution policy twice into this expression, one for pi t to get rid of pi t, and then pi t plus 1, that is to say this one push one period forward to get rid of deposits, you can write the objective of the bank as this. These are profits in period t plus 1. Remember, because deposits and loans and so on are made in period t, profits in period t plus 1 are known in period t. So this pi t plus 1 has a t plus 1 subscript, but this variable belongs to the information set of period t. And this expression is very intuitive. What it says is the profits of the bank is again, have to do with the amount of loans the bank makes times the differential between the loan rate and the deposit rate. Okay, they take deposits, they give loans, and this spread is the net revenue per unit of loans. The same with bank reserves. The difference between the interest on reserves and the interest of deposits is the net revenue of having reserves, minus the operating cost. This operating cost is multiplied by this is immaterial, is multiplied by this interest rate here on deposits because this guy accrues in period T, this cost, and the payoff of loans and reserves occur the next period, right? If this was continuous time, this wouldn't exist here. Okay, so the
sorry, Martin, I just want to clarify.
Yes.
If the bank reserve is fixed by the government or central bank, or each private sector bank can choose optimally as a kind of excess reserve, kind of savings?
They can choose optimally L, and they can choose optimally R, which means that they also choose optimally D, that is to say deposits. So L, R, and D are all chosen by the bank freely, taking as given the interest rate. So the problem of the bank is to maximize this object here by picking, in this case, because I got rid of deposits, by picking L and R, taking as given the rates of return. That's the only thing that the bank takes as given.
Thank you.
Okay, so what are the first order conditions? Well, the first order conditions are micro 101 conditions, right? It says that the spread, the difference between the interest rate on loans and the interest rate on deposits, forget about this denominator again, is immaterial, and it's because the model is cast in discrete time. If this was continuous time, this wouldn't exist. So essentially what the bank is doing is equating the spread, that is to say the lending spread, to the marginal cost of making a loan, right? So it's optimal to make loans until the marginal cost of making loans is equal to the difference between the loan interest rate and the deposit interest rate. And the same with reserves. The bank is going to hold reserves until the marginal benefit, because remember, this profit is this operating cost is decreasing in reserves. So this is negative until this marginal benefit is equal to the difference between the interest rate on reserves and the interest rate on loans. So clearly, the central bank cannot set this interest rate on reserves above the interest rate on deposits. Okay, so this interest rate on reserves can be at most equal to the deposit rate. In that case, these guys would satiate themselves with reserves. Because if the central bank puts it above the interest rate on deposits, obviously these guys are going to run a Ponzi scheme. Okay, so those are the two micro 101 first order conditions, and then there is this balance sheet equation that comes from the profits and the sequential budget constraint and the profit rule. And this balance sheet is the one I showed you before. When I showed you the intuition, I told you the bank receives deposits from foreign lenders and allocate them to loans or to reserves. That was the balance sheet. Now we have the operating costs here, which I didn't mention it before to make the intuition simple, but obviously you have that resource constraint there, resource cost there. Okay, so this is a balance sheet relationship. Okay, so these are the optimality conditions of the bank. Let me quickly go over households, which is the most familiar part, especially for those of you who are familiar with the financial constraint literature in open economies. Households maximize the present discounted value of an utility index that depends on consumption. And that consumption is going to be made up of two goods. It's going to be a composite of tradables and non-tradables. So this is an economy with non-tradable goods. This is the sequential budget constraint of the household. The left-hand side is the uses of wealth. So households are going to use their wealth to buy consumption goods, to buy tradable consumption goods, to buy non-tradable consumption goods. This PT here is the relative price of non-tradables in terms of tradables, or if you want to, the real exchange rate. This dictates how expensive is the economy. The household will use resources to pay back its loans. So these are the households who take loans from the banks. So this is the same L we had with the bank problem, but this is the other side of the counter, right? These guys take loans, they have to pay them back. And then the sources of income are going to be two endowments. So this YT is an endowment of tradables, this YNT is an endowment of non-tradables, and these are going to be exogenous stochastic variables. These are going to be the only two sources of uncertainty in this economy. It's a very simple economy. And the government is going to charge an income tax, tau T. So this is disposable income if you want to. Of course, income includes profits, right? When the banks distribute profits, those profits go to households. And then another source of wealth for these households is to take loans from banks. Okay, so that is the sequential budget constraint. This is the object that is at center stage in this literature, which is the collateral constraint, right? So we take it. You could, if you're familiar with this literature, you will find this very familiar. It says that households can take loans up to a fraction of their income. Okay, so this is income. They can take loans up to a fraction of their income. When the economy doesn't have banks, these loans are exactly the same as external debt. But here there are banks, so these loans need not be exactly equal to external debt. There can be bank reserves in the middle, right? So that is the expression of this collateral constraint in this environment. This price here is the source of the pecuniary externality. These households take this price, this relative price of non-tradables in terms of tradables as given, but collective, their consumption decisions could push this price up and down, and they don't internalize that. So that's the source of the pecuniary externality that creates so many problems in this economy, because if the price falls, these households might see themselves collateral constrained, and that might create deleveraging in the economy, and that can be painful. Okay, so foreign lenders, this block is very simple. We are going to assume that these banks take deposits from foreign lenders. These foreign lenders require to be paid the world interest rate. That is the opportunity cost for these foreign lenders. So if they get paid, they're happy. The country has access to as much funding as they want. The government charges potentially a tax, a collateral constraint. This TAU has a C here for collateral constraint, which is a tax on these capital inflows. Okay, so TAU is a collateral constraint tax, or it is capital control tax on these inflows from the rest of the world. So the effective rate that these banks are going to charge or are charged is 1 plus TAU times 1 plus R. This is charged by the government, and this is charged by foreign lenders, right? So the cost for these banks of these deposits is the combination of these two rates, the tax rate and the world interest rate. This world interest rate is going to be a constant here. We could have had it, exogenous, have an extra shock, but we didn't explore that in this version of the paper. Okay. The government, I told you already, has two instruments, the interest rate on bank reserves, capital controls, three instruments, and the income tax. So let me walk you quickly through the budget constraint of the government. Here on the left-hand side, I have the sources of income, which is the income tax, the capital control income, that is, this is the capital control tax times the amount of inflows of funds from the rest of the world. And another source of revenue for the bank is the deposit, the bank reserves that domestic banks deposit at the central bank. Okay, so these are the three sources of income for the government. And the sources of outlays for the government are that they have to pay back these reserves with interest the next period. And we are going to assume that this government has also an operating cost and a cost of operating this reserve facility that depends on the amount of reserves. If you don't introduce these bank reserves, then the government can really manipulate these reserves freely and can achieve the first best very quickly. So you have to put some sand in the ability of the government to raise reserves, right? So we assume that this reserve facility has a cost, and we are going to calibrate this. Okay, so because I don't have much time left, I want to walk you through the quantitative analysis. Very quickly, I'm not going to walk you through the entire calibration of the model, but the original part of the calibration is the calibration of the financial frictions, right? The collateral constraint, the operating cost of the governments, this gamma function, which is going to be increasing and convex in L, in loans, and decreasing in reserves, right? So when these reserves are less than R bar, having more reserves reduces the cost. Up to a certain point, when RT is equal to R bar, beyond that, we're going to put an indicator there to make it the satiation point. It's not going to be, the satiation point is not going to be relevant for us, turns out, but it's very common in this literature, so we have it there. So, and finally, the operating cost of the central bank of operating this reserve facility, which is also going to be convex in the amount of reserves that the central bank raises, right? The more reserves the central bank raises, the more is the monitoring it has to do. So these are 6 parameters that we need to calibrate. Now, we are going to impose 6 moments from the data that we want to match in picking up these 6 parameters. Right? These parameters here, A, alpha, phi, kappa, and B. And the 6 moments we're going to pick are all related to banking and borrowing. So we are going to take the lending spread, that is to say the difference between the interest rate on loans, IL, and the interest rate on deposits, the reserve to deposit ratio, for which there is data. This is the ratio here. The deposit to GDP ratio, we pick 30%. And then the bank operating cost as a fraction of deposits, for which there is data, about 2%. And the operating cost of the central bank of operating the reserve facility. I didn't know that there was data on that. Fortunately, there is good data on the operating cost of central banks of operating their reserve facilities. So that is very handy for us. And finally, the probability of hitting a collateral constraint, the binding collateral constraint, which we are going to match to the probability of a financial crisis in the typical emerging country, which is 5% per year. This is a 5%. Now, this is a complex calibration because, if you want to match this probability of a binding collateral constraint, you have no alternative but to run the model. So in order to match these 6 moments, you have to run the model over and over again. And this is a nonlinear model with an occasionally binding constraint. So it's a complicated thing, but it's doable. And these are the parameters we get. I tell you this just to tell you how we calibrate the model. So let me go to the results of the paper. We are going to compare two economies, one without interest on reserves and without capital controls. We're going to call that the laissez-faire economy or the unregulated economy, and one economy with optimal reserve remuneration on bank reserves and optimal capital controls. Okay, so we have 2 economies. The laissez-faire economy, 0 interest on bank reserves and 0 capital controls, and the optimal economy in which the bank sets the capital controls and the interest on reserves optimally. So this is the first result. So this is a typical picture that people show in the related literature, which is they compute the distribution of external debt. This is the density of external debt with and without optimal capital controls. This is an economy without banks. And the typical result without banks is that the economy, it is optimal for the economy to borrow less than when the economy is left alone. So this is what is called overborrowing. This economy, when left to its own devices, borrows too much relative to the optimal economy in which the government is setting capital controls optimally. So look what happens when you have banks. The government likes these people to borrow more than what they would do without a government. That is to say, the government would like these guys to be more participative in the loan market relative to what they do in the absence of government. So the question is, why is this like this? So what I'm plotting here, now these 2 pictures are for an economy with banks. These are loans. So what you see here is that these guys are taking more loans under the optimal policy than in the laissez-faire, in the unregulated economy. So these guys are playing the game much closer to the collateral constraint. So these guys have a higher risk of hitting the collateral constraint. Now, why does the government not care about that? Why does the government like this, that households are less precautionary savers and they play the game closer to the collateral constraint? Well, because the government can use bank reserves. Look at this distribution of bank reserves under the optimal policy. Not only it is shifted a little bit to the right, but most importantly, has a very fat tail to the right. So whenever these guys hit the collateral constraint, what the government does is it raises the interest on reserves, inducing banks to deposit reserves at the central bank, and then the central bank uses those reserves to give it back to the households who are collateral constrained via lowering taxes. Okay, so this fat tail here is very, very important in this model because this fat tail plays an insurance role, right? The government, the central bank raises bank reserves by paying higher interest on reserves to banks. Why? Because these guys are collateral constrained very often. So by doing that, they can transfer resources to households via lower taxes. That is the idea. How does that look like in the business cycle? So this, what we are plotting here, and I'm going to finish with this and one more picture so that we can leave at least 10 minutes for questions if you have any. This is a typical sudden stop. So what we do is we have shocks, these endowment shocks in this economy. We run the economy for, say, 1 million periods, and we pick all the windows in which there is a collateral constraint, right? And then we look at the exogenous and endogenous variables around that window of a collateral constraint. We have like 50,000 collateral constraints in 1 million draws or something like that. What this tells you is that the endowment during a financial crisis, what happens is that what leads to a financial crisis is a string of shocks that are very unlucky, right? A string of unlucky shock, of bad endowment shocks that lead this economy to have a binding collateral constraint. Now, what happens with the endogenous variables? This is the economy without capital controls and without optimal reserve remuneration. So this is the laissez-faire economy, the unregulated economy. These guys have to cut consumption severely. Why? Because they are collateral constrained and they have to deleverage. In order to deleverage, they have to cut consumption. How do they cut consumption? Well, why do they cut consumption? Well, because they need to run a trade surplus to pay back the debt. Now, this is exactly the opposite that the intertemporal approach to the current account tells you. The intertemporal approach says they should be borrowing here because they have low income. Temporarily, they have low income. They should be borrowing to smooth consumption. Well, the collateral constraint prevents precisely that. These guys, instead of running a trade deficit, have to write a trade surplus. What happens with the price of non-tradables? Well, because consumption collapses, no one wants to consume, the price of the non-trade good falls, which worsens things even more, because remember, this price of the non-trade good is the value of collateral, entrance in the value of collateral. So these things makes things even worse. What happens in the loan market and in the interest market? Well, loans fall. These guys don't need loans because they are collateral constraints. So the demand for loans falls. Because banks are extending fewer loans, they don't need reserves. Because remember, reserves play the role of reducing the marginal cost of making loans. But if you are making very little loans, your marginal costs are really low. So they don't take much reserves. Let me show you what happens under optimal policy. These two graphs are the same. This is a collateral, it's a sudden stop. This happens when the endowments fall. But look what the government manages to do. The falling consumption continues to be there, but it's a much milder falling consumption. The same with the trade balance. Remember here, they are doing exactly the opposite to what the intertemporal approach to the current account says. Here, they are not going all the way to having a negative current account, but at least the trade balance doesn't improve that much, right? So this is a big progress, this difference here, brings the economy much closer to what the intertemporal approach to the current account says. And because they don't drop consumption so badly here, the price of the non-trade good doesn't fall that much, right? So the value of collateral is much more stable. This is the key result of the paper right here. How does the government manage to make this crisis less severe? Well, look at the path of reserves. Bank reserves under the optimal policy, which is blue, increases during the crisis. Whereas if the economy is left to its own devices, bank reserves fall. Now, why is this increase in bank reserves important? Well, because the central bank then can use this bank reserve to give it back to people via lower taxes. And in that way, prevents the interruption of inflows from the rest of the world, right? If there were no banks, then all of these fall in loans are a fall in capital inflows. This government doesn't want the capital inflows to stop. So what it does is it raises interest rates on reserve to induce people to take reserve, to induce banks to deposit more reserves at the bank. And you can see it here when you look at the spread on bank reserves. Look how the spread on bank reserves increases under the optimal policy, but it's flat under the laissez-faire. Right. The level here is not relevant. What is important is that the spread increases in this case, but it's flat under the laissez-faire economy. So let me conclude. We have exactly 9 minutes for questions. So what we do in this paper is we let me put my video. Now there's no risk that I'm gonna be off the air here. Where is it? Here. So the conclusion of this investigation is the following. We take a off-the-shelf model of collateral constraints that predicts overborrowing. We base our analysis on the observation that these models don't have banks, and in reality, we see bank intermediation. When we introduce the bank into this model, the overborrowing result is overturned for underborrowing. So that is to say, the government would like these guys to borrow more than what they borrow in the absence of a government intervention. And the way the government induces a better equilibrium is by having a counter-cyclical interest on bank reserves policy, a counter-cyclical bank remuneration policy in which during recessions, the central bank increases the interest rate on bank reserves, to induce banks to deposit more reserves at the central bank. And then the central bank uses those reserves to put them in the pockets of people via a reduction in taxes. And in that way, it offsets the fact that households are collateral constrained. It helps these collateral constrained households in that way. So bottom line, these papers suggest that the optimal management of bank reserve policy should be strongly counter-cyclical management of those interest reserves. That is to say, during recessions, central banks should induce banks to remain liquid. Okay, I'm going to stop here in case there are questions. I would be happy to address any questions you may have.
Thank you very much. Any questions from floor? Come on, please. You can. This has a mic too. So if you speak to this.
Morgan, can you hear me?
Yes, I hear you clearly.
Yeah, sorry, but this is Thomas speaking. Thanks so much for the very nice lecture. It's very easy to understand the key points. So let me just phrase it in a different way, right? So what, if I understand correctly, when the emerging market is in recessions, they're facing capital outflow, right? So in that sense, it's more good for the central banks to provide insurance, right? So this sort of a function of the insurance provided the central bank or the government, I should say, to protect in a way to provide the money to the banks to make a deposit. Am I correct? Is that a way that we can interpret this sort of a insurance mechanism, like this hedging mechanism? But is it the question which I have is it should we have done it ex ante or should we light on the moment of the crisis? What technical way is it going to be? Do we need certain amount of sort of a bank reserve remuneration in ex ante, or is it only time at the onset of the crisis?
This a very good question. And as it turns out, there is an ex ante component here in the sense that this central bank is playing a role of lender of last resort. So that role is played starting at the moment in which there is a probability of a future collateral constraint in the immediacy. That is to say, in any period in which there is a positive probability that next period the collateral constraint is going to be binding, it is a good period for this bank to start raising interest rate on bank reserves to make sure that these banks are liquid. So there is a ex ante component to this policy that is very important to ensure that the economy can safely play close to the collateral constraint because they know that they have an insurance coming from the government.
Thank you very much. I guess from the floor again, Matsumoto-san. Yeah. If you speak loudly, this can be.
Thank you very much for a very insightful paper. So I'm Hidehiko Matsumoto at the BRICS. So my question about the kind of policy tool. So in the model, households are subject to the borrowing constraint, and this borrowing constraint is associated with the pecuniary externality. So to me, it looks more natural to think about a tax policy on loans rather than capital controls or reserves. So is there any reason why you don't consider a tax policy on loans? And also, what would be the optimal policy or outcome if you think about a tax policy on loans? That's my question.
Yeah, they are equivalent in some sense. That is to say, remember that a tax on inflows, what it does, it increases the cost of raising funds, and that there's a pass-through to loans, right? So there is a sense in which we could have placed the capital controls on either side of the counter of the bank with similar results. Now, what does make a difference, not for the allocation, but for prices, for interest rates, is where you place the collateral constraint. That is to say, do you place the collateral constraint at the level of the household, or do you place the collateral constraint on the side of the banks, right? That makes a big difference because in one case, what happens in a recession is a reduction in the demand for loans. Households are collateral constraints, so they don't demand loans. Whereas in the other case, a collateral constraint means a cut in the supply of loans. And it turns out that the real allocation is the same, but the effect on the lending spread is very different. When the supply falls, the lending spread increases during crisis, whereas in this case, in this economy, when the demand falls for loans, because it's on the side of the households, the spreads fall. And we were puzzled about that because our intuition was that lending spread during crisis increase, but it turns out that they don't. It turns out that they are, let me show you, that these are lending spreads during the global financial crisis. And as you can see here, there's very action, especially if you look at the scale of these spreads. In this set of countries fall, the spread, and in these countries, they start at a certain level and then they end the crisis at an even lower level that they started. So there's a beautiful paper, historical paper. Let me see if I can find it. Well, I cannot find here the quote, but there's a paper by a very good historian from Rutgers called Rockoff. And he documents that one reason why the government in the United States failed to act quickly during the Great Depression of 1929 is that the advisors of the government were saying, look, the lending spread is not moving, it's actually falling, so we don't have a financial crisis. The problem is not in the financial sector. And Rockoff argues that that was the reason why it took so long for the government to take measures to rescue the bank, to play the role of lender of last resort, is that they were waiting for the lending spread to go up. And the problem was that the demand for loans was very low. So that is why there was a financial crisis, but no increases in spreads.
Okay, thank you very much.
Thank you very much. And Shioji-san on the online have a question.
Yeah, can you hear me?
Yes, I can hear you
Oh,
clearly.
good. It's Roshoji from Hitotsubashi University, and thank you for the great presentation. So, I had a question about this constraint optimal policy, so which requires that at the time of how do you say, binding collateral constraint, it requires two things. One is to raise the tax on reserves. The reserve, the interest on reserves, and at the same time requires the tax rebate, the reduction of the taxes on households. I think I've understood the role of the first one, the interest on reserves, but do you really need the second one, the repayment or the reduction of the taxes, or does the interest on reserves by itself does much of the job? So that was my question.
No, you absolutely, it's a very good question because it allows me to clarify that point. It is absolutely necessary that the income tax falls because remember, by increasing the interest rate on bank reserves, what the government achieves is that banks deposit more funds at the government, right, at the central bank. But then the government has to do something with those funds, has to make them reach the households who are borrowing constrained to allow them to smooth consumption during the recession. And the only way the government can do it, or one way the government can do it in this model, is by lowering taxes. So lowering taxes is a key ingredient to have those funds. So the interest on reserves manage those funds to go from foreign lenders to banks and from banks to the central bank. And then the lowering of the tax allows these funds to go from the government to the households, which is the agent that the government really cares about. And that allows the households to smooth consumption. So the two things are crucial. That is to say, the increase in interest rates on bank reserves and the lowering of taxes are both crucial.
Okay, thank you very much.
Thank you very much. And one more chat from the chat. We have a Hamada-san, Waseda University, have a question. Can you talk?
Somehow the chat doesn't enter. If someone can read it, because I don't get it here.
Yeah.
They may need the questions, right? So Hamada-san has a question. What about the consumption tax? Is it possible to restore the optimal tax with reserve? That's his question.
Well, here we did it with an income tax because if you think about it, in this economy, an income tax is really a lump sum tax. Why is it a lump sum tax? Because the endowments is an income tax, right? The endowments are exogenous. And the other two components of income, which are the price of the non-trade good, the price of the non-trade endowment, and the profits from the bank, are taken as given by households. So the income tax doesn't distort the households' decisions. That is why we introduced it there. Now, the problem with having a consumption tax as a substitute for that tax, I'm conjecturing because I haven't done this exercise, so I don't, I'm not in a position to give you a precise answer to your question, but my hunch is that a consumption tax is going to get in the way of the capital control tax, because the capital control tax at the end of the day is a distortion on the intertemporal allocation of consumption. So my hunch is, or my answer to you, preliminary answer would be that I'm not sure whether you can achieve the same allocation with the consumption tax, because I think that the consumption tax is gonna be in the way of the capital control tax. I don't think you are gonna get there two fully independent instruments. That's what I'm trying to say.
Thank you very much.
Thank you very much. And then just from me, I just thought because in the end the banks kind of losing where to lend, because suddenly collateral valuation going down, so the banks cannot lend. But at that moment, a central bank are willing to borrow from bank, in a sense, getting more reserves. So in that sense,
Yes.
I think it's more like not the lender of last resort, but more like a borrower of last resort, I thought. And then that's a way to give back money to banks and then give that money back to depositors. That's
Yes, yes, that
borrower
is.
of last resort, not lender.
Yes, that is absolutely right. If you want a lender of last resort to households, because in some sense it is giving households who are collateral constrained resources, but then it's getting those resources back in the form of increases in taxes. So at the end of the day, the households pay back those loans in quotes. But from the traditional way of interpreting lending of last resort, which is to go and rescue banks, you're absolutely right. It's a borrower of last resort from banks. Absolutely right. So the lender of last resort that we had in mind was, in quotes, lender to households in some sense, because it's giving them resources, but not for free, right? The households know that sooner or later they will pay them back with higher taxes.
Thank you very much. Everyone is fine. Thank you very much for your great speech and
I appreciate it.
Thank you very much. And
No, it was great to be here.
Yes.
Let me stop my sharing here.
Yeah, sure.
Thank you very much again for the
Very much.
invitation. So it's a pleasure to be here.
Thank you.
Thank you. Thank you. And if you have some time, please stay. We continue the conference. Of course, if you're busy, go out. Monica, I think you are in the night time, I believe.
No, but I'm glad to stay for a while longer, because there are interesting papers to come. But at some point I will have to go to bed, because tomorrow I have appointments very early. But for the time being, I'm going to stay here.
Thank you very much.